Jason Browne is our first presenter. His title is ETFs and Asset Allocation in a Low Yield World. He's from Bethlehem, Pennsylvania. He's a chartered financial consultant and president of Alexis Investment Partners, which I found out is his daughter's name. Has been an investment advisor since 1995. His passion for taking complex concepts and making them simple, and his background as a tactical investment manager has made him a frequent guest on CNBC, Bloomberg, the Nightly Business Report, Fox News, the Ameritrade Network, and numerous other publications. Browne's prior role included Chief Investment Officer, Chief Investment Strategist, President of a series of mutual funds, Portfolio Manager, Investment Advisor, Financial Consultant. Browne earned his MBA from St. Mary's College in 2008 and his BA from San Francisco State University in 1995. Jason, you have the floor. You can take about an hour and 15 minutes, and we will intersperse questions as they come from the audience. So you have the podium, Jason.
Excellent. Well, thanks so much for having me. One clarification, we've actually moved from Bethlehem, Pennsylvania to Montgomery, Texas.
Oh.
So that's why it looks a little brighter in the background. Anyway, I'm very happy to be here. I'm going to try to move pretty quickly because I've got a lot of material. At the same time, absolutely welcome your questions. I always like to take the assumption that if one person has a question, other people are thinking. So I'd like to, obviously let you interject as we go. For some reason, it is not advancing my slide. Oh, there we go. So we promised you in the announcement that you're going to learn three things. Why long-term performance of stocks and bonds may be a misleading framework for financial planning. Some alternatives to the traditional balanced portfolio. So things you can maybe consider incorporating into what you're doing now, maybe. And then a little bit about when, why, and how to adapt as interest rates start to rise. And I think it's a great time to be doing this. We talked about this topic months ago, but given what's been going on so far this year to date, for example, I think you'll find some of what we share with you will maybe resonate a little bit more than when it was just theoretical. All of this said, let me give you a few quick disclosures before we get started. Obviously, this material is for informational purposes only. If I was going to be providing advice, I would need to base that off your individual circumstances. Anything where we talk about performance, past performance, not being indicative of the future. Obviously, it's something that we want to learn from what we can observe in the past, but we always know that we don't have a crystal ball about what's going to happen coming next. Anything where we're talking about mutual funds, rebalancing, things of this nature, recognize that there's potential trading costs and other things, taxes and so forth, that may not be perfectly reflected in the charts. And several of the slides that I'm presenting are produced by third parties like JP Morgan or other entities. I cited all of those sources, and we're available. I'll try to let you know where you could find more online, because I know you guys are obviously willing to be here on a Saturday morning, so you're eager and interested in learning more about these topics. So I like sometimes to try to interject things that you can kind of stay updated on if you want to. So, and if you ever have any questions and you want to contact me offline, my contact information will be there, and I'll be more than happy to, again, provide any updates. So a little bit about me. I'm not going to spend a lot of time on this topic, but I'm one of those people that's not afraid to have and express and share my opinion. We also archive, this is a page off of our website, the various either content that we produce or interviews that we do. So people can kind of look back and we can look back and hold ourselves accountable and say, what were we kind of thinking and saying and doing at various kind of points in time along the way. Most of the interviews are kind of high level about asset allocation or market cycles, things of that nature. That's probably what I'm most passionate about. But sometimes we'll get on, I think last conversation was about casino stocks. So we'll talk about individual things along those lines. If I don't have anything to share, I'll let people know that. But most of the time, again, I'm more than comfortable sharing my opinion as long as people are willing to accept, like I said, that I'm just sharing the observations of my 26 years or so as an investment advisor, investment manager, trying to help people manage and grow their wealth and trying to give people a picture of how did I kind of come to my way of approaching investments. and why do I pay so much attention to things like risk management, things of this nature, and how do I approach changes in information and build that into portfolio construction, which is part of the reason why I'm so passionate about a topic like ETFs, is because they really give so much flexibility and such an easy way to make kind of thematic adjustments in your investments. And we'll touch on that as we go along. So key thing from our firm's perspective when we're thinking about managing money is we always try to make sure that anything that we're talking about, thinking about, or doing comes from a very practical perspective. And so if it's not something that we can explain at a very simple level, it's probably something that we're overthinking that is going to get us probably into more trouble and it's going to be helpful. The other thing is we want to always be focused on things that we can know and can control, and recognize other things that are maybe more our fears of what might happen, or our concerns about what should be happening that we can't observe, and really just try to make sure that we're paying attention to what's actually happening at any point in time. So some examples of things you can know and control. What are your goals? Do you have the resources to fund these goals without taking risk? What are the assumptions that you have in terms of the returns that you're expecting in your plans, and are those realistic? And then I think it's really important to plan for contingencies. What are you going to do if things don't go as planned? And equally important, what are the consequences if things don't go as planned, not just to you, but if you're investing with your family members or so forth, what's the consequences to them, just to keep you in check, because the way things tend to work in the markets, and we'll again sort of get into this a little bit as well, is it just gets very tempting sometimes to play catch up if you fall behind or things of that nature, and or to try to pursue things that maybe aren't quite there. And so you want to make sure that you're in a position where two things happen. One is, if we saw recently, for example, the sell-off that took place because of too much leverage, and a scenario where you can be forced out of your positions, even if they might be good long-term holdings, at inopportune times, and that can cause you to kind of lose money. The bigger picture for me is, if you're in a situation where you don't have to take a lot of risk to earn your desired rate of return, and you have kind of already won the game, so to speak, you have to make sure that you don't put yourself into a position where all of a sudden now you've got to scramble, you've got to do something in order to kind of get back in the game. Make sure that it's worth it, whatever incremental benefit you like to have happen. I'll talk a little bit about, there's obviously lots and lots of reasons why people invest. They invest for college savings, they invest for all kinds of different goals. The one thing that most people have in common is they don't want to run out of money, right? They want to have that ability to fund their retirements, to build wealth, and then to spend that wealth, and to feel comfortable doing the things that they want to do throughout, knowing that there's going to be hopefully a very long time. One of the things I think we can all appreciate is that we're living longer, and especially if you've got a significant other, the chances of one of you living into your 90s is actually quite high at this point, and so forth. So from the point that people are retiring, we're just living longer, and we need to have our money continue to kind of be with us long term. At the same time, a lot of people, when they enter retirement, they're afraid to spend money or do things that they want to do because they're used to getting a paycheck, and now they're worried about not being able to do something out into the future. And it's really important to have that balance, and also recognize that that it is equally important that you don't not do things today because you're worried about not being able to do them in the future. So again, it's all about having that confidence that you're going to make it. So this slide here, and I'm going to touch on this just very briefly, is just an example of being too risk averse. So a lot of times when we think about risk management and so forth, we think about people maybe taking on too much risk and getting forced out of positions. This chart was produced from a program called Riskalyze. It's just a sort of a simplified financial planning kind of a software that assigns a risk level to a portfolio, risk level of 1, as this is showing, it's just a cash investment, and then lets you plug in an amount of money and an amount of time, like a time horizon, and you can put in this case, it's somebody that was born in 1954, life expectancy out to 90, inflation rate at 2%. And they're trying to basically draw an income of about 5% a year out of their portfolio. And the key thing is, if they're not taking any risk, you can see that they're kind of guaranteeing themselves that they're going to run out of money, right? So if we then turn and look at sort of the current environment that we're in, and this slide is from JP Morgan's Guide to the Markets. It's showing basically the last 26 years. And each of those bars are the interest rates that you'd get guaranteed sitting in a savings account. And then the lines, I think you can see my cursor here, these lines here represent the income needed to just keep pace with inflation. And what you can see is back in the 90s and for kind of the first half of this chart, you actually had enough earnings in your savings account to at least keep pace with inflation. If you put your money in the bank and you were trying to save money to, meet some kind of a goal, whether it's an education goal, keep up with medical expenses, be able to kind of at least preserve your purchasing power, it was a safe place to do that. But really post-financial crisis, and for much of the time, even since the tech meltdown in early 2000s, that hasn't been the experience. Interest rates have been much lower than the rate of inflation. So it's been punitive to have money in savings. So again, we'll kind of think back to that, why people invest and so forth. One of the reasons is we're kind of forced to, at least in the near term. And we'll touch on, again, this is going to change over time and how does that impact our asset allocations? But, the other last point I would make on this particular topic here is having a decade or longer where interest rates have been this low has created other, interesting phenomenon in our lives as well, in that people have gotten more and more used to paying for things with credit than paying for things with cash. And so asset prices in general, the price you pay for a car, the price you pay for a house, all these other things have really adjusted up to that phenomenon, kind of like we're doing Zoom meetings today instead of meetings in person and so forth. And so our ability to tolerate higher interest rates is probably somewhat more diminished, which, again, may perpetuate this cycle for longer than many of us expect. So, obviously, you've seen different versions of this type of slide, I assume, before. This is just talking about the time value of money. And I tried to put it into a little bit different perspective. When we look at the rates of return over the long term from different investment types, the reason this is 3%, 6%, 10%, 12% is those are kind of aligned with the historical long-term rates of returns from cash of about 3%, bonds of around 6%, and stocks of sort of 10 to 12%. Obviously, in the current environment, cash is yielding 0 to 1%, and bonds are yielding sub 2%, unless you're taking a certain amount of risk. But what I wanted to share is if you had $250,000 and you were investing to try to accumulate money for retirement 20 years into the future, it really makes a profound difference earning that extra couple of percent on your money. So again, just sort of one more reason why people take risk is $250,000 invested at 3% for a 20 time frame ends up being worth about $450,000. At 6%, it's $800,000. At 10%, it's closer to $1.7 million. And if you then turn around in retirement and say you're going to draw 5% income off of that ending balance, these numbers here kind of correspond not to this rate of return, but to that balance times the 5% income, just to give you a sense of what might be a reasonable withdrawal rate or reasonable income you can supplement based on that accumulation. And this is sort of the last slide I'm going to put on this particular topic. But this one, again, from JP Morgan's this time Guide to Retirement, touches on the other reason why it's important to take risk, which is if you are withdrawing, let's say, more than 3% from your portfolio, and you're not taking any risk, you have your portfolio 100% in cash, what you'll find is you pretty much guarantee yourself, as I showed on that first chart, that you're going to run out of money within 30 years. You're just not earning enough yield to, you kind of bleed to death, if you will. As you get further out here, what's interesting also is if you're only withdrawing 3% from your portfolio, you suffer some fluctuations in the value of your portfolio, but it actually historically hasn't added any risk to your ability to continue those withdrawals for 30 years or longer. So there's not a negative outcome scenario, but there's tremendous positive. And if you need to withdraw 4%, there's actually still a very high likelihood historically that you would have been able to do that from even a 40% allocation to equities, for example. And as you kind of go larger and larger in here, your potential to potentially have your money last longer just increases and increases over time. And that kind of leads people to what we see here, which is, this is a chart that shows the long-term return from stocks averaging, this is 70 years, so since 1950, averaging about 11% annualized, bonds averaging close to that 6% I mentioned before, 5.9 this particular window of time, and a portfolio that was 50% in the S&P 500 and 50% in an aggregate bond index, averaged about 9%. Again, this is 1950 through 2020. Now, in any one year, stocks have lost as much as 39% or made as much as 47%. Bonds are substantially less volatile, but they do lose money at times, and the balanced portfolio kind of splits the difference. As you go out looking at rolling 5-year, 10-year, or 20-year periods, what you find is you have basically no losing periods for stocks, even over a rolling 20-year window of time. And so people tend to feel more comfortable having a bigger allocation to stocks for longer term allocations than they do for shorter term allocations. And that kind of tends to lead people to, when they put all their pieces of money together, incorporating that into a balanced portfolio. The most commonly used for long-term investing is 60% stocks, 40% bonds. And part of the reason for that is it's worked historically. So I showed you before that Riskalyze chart showing the person that had the $500,000 was drawing 5%, guaranteeing themselves they were going to run out of money basically in here. What this one shows is when you do the Monte Carlo analysis on an investment in a balanced index fund, most of the time you end up eking out a little bit of extra gain after a 5% withdrawal. If you get lucky, you end up in here. And even if you get unlucky, it's pretty rare that you would run out of money after a 30-year time horizon. That said, this is another way of looking at what's actually happened over the last, in this case, from 1958. But if you want to look at just the last 30 years or so, it's kind of this right half of the chart here. This is 10-year treasury yields. And you can see here that the average that we were talking about earlier, that 6%, has happened in a very interesting way, right? You started out at around a 4% yield back in 1958. You peaked out at around a 16% yield on the 10-year treasury, and you've kind of worked your way down to where current yields as of March 31st of this year was 1.74%. We're slightly below that at the moment, but you can see that the yield today is dramatically below not just this average, but certainly where it's been the entire time over that time frame. So one of the first questions I would pose to everybody is it realistic to assume a 6% forward rate of return on your fixed income investments that was based on the average experience over an environment that looked like this when you're starting in here at substantially lower yields? And what I would propose to you is that historically, when we look back, the actual return on fixed income tends to be quite close to the yield at which you start. There are windows of time, like we saw early last year, when yields can be 1 or 2%, and they plummet down to 0.5% because there's an event that's taking place that's forcing them down, and people can look at their bonds and say, wow, they did really well here. But if you hold those bonds to maturity, you're only going to get the yield that they generate. And on average over time, as we're starting to see now, as things get better, yields will start to normalize and go back up, which impacts that liquidity and brings that total return back into that lower level. The reason that's important, if you're looking at a balanced sort of portfolio plan and you're projecting out a rate of return that you need in order to reach your goals, is just to recognize that if you're basing that return assumption on half your portfolio earning 6%, and it's more realistic that it's going to earn 2 to 3%. And that's if you're willing to, even maybe take a little risk or be a little bit active there. That puts a lot of pressure on your expectations from the other parts of your portfolio, equities and things of that nature, or you may need to consider some different alternatives in the mix. So this slide is one that I always like to show that kind of touches on the idea of what I see as one of the challenges when I work with people as a financial consultant on financial plans, is all of the financial planning software that I work with, they always do different Monte Carlo things and show various potential outcomes and talk about past performance not being indicative of the future. But then they take the return assumptions in the plan and they base them on historical average rates of return. And if you look at the tables that they generate to say how much do you need to invest and what are you likely to have as your outcome, it's based on this sort of line like you have at the top, as if you're going to get that average return over time. And the reason they kind of feel comfortable doing that is they're assuming that you're going to kind of experience random ups and downs along the way, but it's all going to average itself out. Now, the problem is that reality looks more like what you see here at the bottom. You may get from point to point and at a rate of return of 6%, 7%, 8%, but you're going to get there in an interesting way. And life's going to throw a lot of hurdles at you. And the important thing from my perspective isn't to look at that and say, oh, well, I can't trust the plan, but rather that you plan for these very predictable contingencies to take place, whether that's markets going up and down in cycles, whether that's potential for having job losses from time to time, or what things might be vulnerable to you, particularly in terms of things that you're going to face along the way, and having that sort of built into your plan so that you have kind of a way to use volatility and other events in your life to your favor, or make sure, if nothing else, that they don't kind of pull you emotionally and otherwise off track. So I'm going to give you a couple of examples of things not going people's way, and that may be intuitive or less intuitive. This first one I found interesting. Again, JP Morgan's Guide to Retirement in this case, and this is just the expectation of workers when you survey them about when they plan to retire, and the actual experience, which surprised me. We keep hearing more and more about people working longer and longer, and that's absolutely an increasing phenomenon. But it's really not the average experience of most people. Most people plan to retire at age 65 or older and actually retire closer to age 62. Sometimes this is for reasons that were basically favorable. They found out that they could afford to retire earlier. They wanted to do something else. Other times it was things that were maybe beyond their control, health problems or disabilities, changes at their company, needing to care for a family member, skills becoming outdated, a variety of other things along those lines. I think the important thing to keep in mind here is we want to plan for what we think is the outcome that we desire or just makes sense to us initially, but we also want to recognize that things may come out a little differently. And if you do allow for that in your plan, that you might retire early because that's what most people seem to do, or something along those lines, and you end up working a little longer, what you find is everything functions fine. So I think when we're building plans or we're thinking about the return we need to generate and so forth, or the amount of risk we're comfortable taking at different stages of our life, we just want to make sure that we build in these contingencies that would, again, cause us issues. This particular slide, it's one that we've heard a lot about, but is maybe a little bit counterintuitive. It took me a little bit to absorb. So this is a slide showing a person who in 1966 assumed that they were going to withdraw 5.2% initially out of their portfolio. And they were comfortable with that because they thought their portfolio would earn about 8% annualized. And they put 40% in stocks and 60% in bonds because bond yields were high and they didn't feel comfortable taking a lot of risk. And guess what? Their actual portfolio return over the next roughly 30 years was 9.1%. So it was better than the 8% that they were targeting. And yet they ran out of money. And you think about that and you say, that doesn't seem right. And yet what happened was this. They started withdrawing their money back in 1966. They were taking 5% out. And for that first roughly 15 years, unfortunately, they were having a very bad experience in the markets. They were pulling 5% out. They weren't earning anywhere near the 8% that they were looking to earn. Their balance was decreasing rapidly. And so even though returns in this second half from 1982 forward were well above average, and the total return over this full 30-year window was actually above their original projections, they had depleted so much of their savings that they just couldn't make it up on the other side. So we call that sequence of returns risk. If you're a saver, this kind of a pattern is actually the ideal world, because you're putting more and more money away during this period and you've got it invested and you make a ton of money on the back end. But if you're at or in retirement and you're taking money out of your portfolio and the near-term performance suffers, it can throw the whole portfolio dramatically out of whack and really hurt your long-term plans. So, basically what this chart here is showing, and I've seen different versions of this throughout my entire 26 years or so investment career. The numbers are different. So when you look at the last 20 years, or in this case, it was 1998 through 2018, I can get you a more current version of this. But it shows REITs doing best, then gold, then oil, then the S&P down here, and balanced funds and sort of the S&P were similar because bonds and the S&P were similar. Again, just considering that if you started in 1998 and went through 2018, you went through some pretty big downturns and so forth along the way. But the average investor ends up, I don't know if you see my cursor here, way out here on the right, dramatically underperforming the investments that they were selecting along the way. And the reason for that is that what tends to happen for people is if they're invested somewhat conservatively and they have a plan in place, and then they see other people making more money than they were making, the tendency is they look around themselves, they see that the economy looks good, and the news seems good, and everybody's doing well. And so they let themselves get a little more aggressive. And then what happens is bad things happen, market turns down, the economy starts to get bad, news gets bad, and so forth. They've gotten themselves maybe a little more aggressively positioned than they were really comfortable with for the long term. And sure enough, they abandon their plans and they underinvest. They maybe put more money more conservatively at that point, and they lock in some losses. And then, of course, the market turns up and the cycle kind of continues. So I think the important thing to recognize here is if you think in advance about markets and cycles and things of that nature, and you plan for those things, you're more likely to stick with your plan and end up having an experience closer to the asset class that you're invested in than if you allow yourself to get derailed and react emotionally. The other thing that's more optimistic on this chart that I do want to share briefly is this top section. So this is just showing from the peak of the market in 2007 through the great financial crisis, and then obviously out through the end of the period here. And this more volatile chart is just investment 100% in the S&P 500. This one's 60-40, 60% stocks, 40% bonds. And this one here, 40-60, 40% stocks, 60% bonds. And these lines represent when you broke even. So a lot of people think that the main reason to have a diversified investment portfolio is to avoid the pain of major drawdowns. I would say the more important reason for somebody at, near, or in retirement is this other area, the fact that even in the great financial crisis, by the end of 2009, somebody that had only 40% in stocks was already back to even. Somebody that had 60% stocks by October of 2010 had broken even. So if you're withdrawing money out of your portfolio, you weren't underwater for a very extended period of time. Somebody 100% in the S&P 500 didn't get back to zero until March of 2012. And so if you think about that, roughly 5-year window of time of taking money out of your portfolio while your portfolio was underwater, you can see where that can do tremendous damage and derail your plans. So with that, I'm going to start talking a little bit more specifically about, I'll call it that traditional balanced account model and some alternatives that can help you through some of the more difficult times. So this chart is from Investors Fast Track as a tool I like to use for charting, and you can also do back testing and things of that nature. And it shows from basically the last 30 years, from mid 1991 through just about a week or so ago. Stocks are represented by the Vanguard S&P 500 Index Fund. Bonds are represented by the Vanguard Total Bond Index Fund. I'm using these mutual funds at this point instead of ETFs just because they've got a longer history. And this balanced portfolio is just 60% stocks, 40% bonds, rebalanced on a quarterly basis. I've added 3 lines to the chart. One is what would have happened if you had your money invested at a steady 10% rate of return. That's the top line here over the same full 30-year window. One is that 6% rate of return, and one is 3%, which in addition to being kind of long-term performance of cash, which obviously is currently under that level, it also is the long-term rate of inflation roughly. So I think it's always important to have kind of something other than the zero line on the screen. And what I think is interesting to look at is the last 30 years, sure enough, stocks have returned right around that long-term average of 10, 11%. Bonds have been very close to the 6% line. And so forth. The balanced account was in between the two, close to that 8% that I was showing you on our prior assumptions. So it all looks pretty consistent with the very, very long-term scenarios, but they get there in a very interesting way. So you'll see windows of time when returns were dramatically above that 10% annualized. And obviously the implication to that is there's extended periods where they're also below. So for example, if we were to start instead of 30 years ago, 21 years ago, at the end of 1999, beginning of 2000, I'm speaking to a Silicon Valley group, so the tech meltdown and that whole time frame is probably one that we all remember all too well. But this now I'm showing a 10-year window of time, so from 2000 through 2010. And I like to start with this window because most people think, well, as long as I've got a time horizon of 7 years or longer, I can kind of consider that long term, and I don't have to worry too much about the fluctuations in the market. This shows a 10-year window of time where the performance of stocks wasn't just below average, it was actually negative. And so not only were you riding this huge roller coaster ride going up and down 50%, and then you recover, and then you go down again, dramatically, and then you recover. But the total return over that full window was actually a negative rate of return. Balanced portfolio did better, definitely quite a bit better, did recover quickly, as I had mentioned earlier, and so forth, but still only averaged less than 3% annualized. Interestingly enough, bonds actually performed pretty much in line with the long-term average over this particular window. Granted, back in the end of 1999, you could earn almost 4% on your checking account and get about 5 or 6% interest rate from your treasuries. Now, if I extend this out to today, so I'm still starting at 2000, but now I've been invested for 21 years, we can see that stocks and the balanced portfolio have actually had about the same rate of return, and it's still only about 6% annualized. Bonds started out real strong, but as we showed you on the prior chart, yields have been very depressed for about 10 years now. And that drags the total return even over this 20-year window down closer to 5% for the aggregate bond index. And I'm not trying to say this to be negative. Obviously, there's been windows of time here that have been absolutely phenomenal, but more as a way of saying that even for a very long period of time, in this case, 21 years, there's a certain aspect of when you happen to start investing that has a pretty dramatic impact on your total return if you're a buy and hold investor and the only asset classes you're considering are stocks and bonds. And so that's going to bring me to, I'll call it my first solution, if you will, to what do I do if I'm investing today and I think it's unrealistic that the future returns from stocks and bonds are going to be as high as the long-term average. So I'm back to that 10-year really bad window of time of 2000 through 2010. And this chart looks really busy, so I'm going to take you through it for just a moment. The red here is still the S&P 500. That's still that Vanguard S&P 500 index fund. The green line here, the one that looks really steady, is still bonds. This is the traditional balanced portfolio, 60% stocks, 40% bonds, rebalanced on a quarterly basis. And I've just added two more asset classes. So in this case, gold, and I'm just using the spot gold price. That's what this represents, as opposed to a fund, because most of the funds that invest in gold stocks, which are quite a bit more erratic. And then REITs. This is just the Cohen and Steers REIT fund. It's been around for quite a long time. So I'm just using that to represent. And then I've got this portfolio called four-way. It's not complicated, but it's just an equally weighted allocation between stocks, bonds, gold, and REITs, 25% in each, rebalanced quarterly, just like we were rebalancing the more traditional balanced portfolio. And what you can see here is that the volatility of this portfolio is very similar to the volatility of this portfolio. But during this window of time, this one, obviously still returned your 8% annualized roughly, whereas this one was sub 3%. If we extend that out for a little bit longer, it's going to look like a weird time frame here. So let me walk you through it. Now I'm going from 2005 to current. The reason why I'm using 2005 is I've substituted ETFs for each of those asset classes. I apologize, I accidentally advanced the slide there. So in this case now, the red, instead of being the Vanguard S&P 500 Index Fund, it's SPY. The SPDR S&P 500 ETF, AGG is an iShares Aggregate Bond Index, ICF is Cohen and Steers Real Estate Fund packaged as an ETF. It's slightly different, but it's basically the same. And then GLD to do gold. And the reason this starts in 2005 is that's the earliest time all four of these ETFs happen to be in existence. And you can see in this particular window here, again, chart looks very busy, but again, the volatility, even through very adverse periods of each of these portfolios, is very similar when you allocate among the four asset classes or you do the traditional balanced portfolio. What may not be as obvious, because they start at a similar place and end at a similar place, is they get from point to point in very different ways. So each of these four asset classes does operate in its own cycles. Sometimes they look like they go right alongside each other. Other times, one sort of zigs when the other one zags. And that's just important to kind of keep in mind, is to the extent that you are comfortable deviating from that sort of traditional allocation between stocks and bonds, there's going to be windows of time when it probably is going to feel uncomfortable because the traditional portfolio is going to outperform. I did want to show one more slide with these four asset classes, taking it back to 1991. So going back to that sort of 30-year time horizon to make the chart look a little less complicated. I've still got all six charts here, but I just sort of pointed to gold, bonds, REITs, and stocks. And the reason I wanted to share this was when we look at a chart of any one window of time, like if I look at that 2000 through 2010, or even the 2005 forward, gold looked, for example, really pretty stellar. At the same time, if I expand it out here, you can see that the long-term performance of gold is maybe a little less stellar, closer to bonds, and it can suffer for extended windows at times. Sometimes when stocks, for example, are doing well. Other times, though, stocks are going up and gold's going up at the same time. The key thing to think to kind of wrap our arms around is, a lot of people think of one item as maybe a hedge for another, or something that will do well when the other one does poorly. My experience with these four asset classes is they just operate on their own cycle. So they are cyclical. I like the idea of having a broader tool set simply because you can invest in them very easily at this point with ETFs and so forth. You can make changes easily. And the overall level of volatility and that sort of lack of correlation between these asset classes really does create some risk management tools that you simply don't have if you narrow your focus only on traditional stocks and bonds. So for example, to get through that window of time, where stocks are doing poorly and bonds are doing poorly at the same time, that balanced portfolio is just not working very well. If I can only invest in those two asset classes, my only choice is to try to time the market and move in and out and win by trading. I might be able to add a little bit of value through stock selection and things of that nature, but I'm really very limited. If I incorporate other asset classes into the mix, I actually now can have a situation where, because of that lack of correlation, I still may stand a chance anyway of doing well. So I want to kind of, yes.
Before you move forward, I believe we have a question from the audience, actually from Richard. Richard, would you like to unmute yourself and just ask your question?
All right, so given that the pandemic has caused some large companies such as Salesforce to ditch office space, and given that some states such as and cities such as California and San Francisco are in the process of trying to give people who are out of work a pass on paying rent, well, shouldn't that be bad news for REITs and potentially your four-way plan on a going forward basis? So this is not something you can detect in past data because it's in the now space, but has more of a potential impact on going forward.
Yeah, I would say, to me, that I think it's a great question. And I wasn't trying to say this is my plan, by the way. I'm just saying this is something to consider over time that has had some historical merit as a way of kind of opening doors. I would say with REITs, my own personal experience with this was back in 1998, 1999. I was buying REITs because the yield you could get on them was close to 18, 19% annualized. They were just out of favor. Everybody wanted tech stocks. Tech stocks were doing unbelievably well in the late 90s. And so they just weren't willing to put money into REITs. And so they were operating at these very depressed yields. Now, even with them being somewhat out of favor, yields on REITs are closer to that 4 or 5%. Obviously, you've got potential issues, as you pointed out, with office space and things of that nature. For me, the big issue, whoops, I apologize, is really more that function of the yield that you're getting out of there not being anywhere near what it was historically, and so questioning how good the valuations are should interest rates start to rise. I think in terms of identifying, though, when is a good time to own REITs or not, I'll share with you some thoughts in a few moments. I would say the fundamental issues that you've brought up previously would be in many ways less critical from my perspective, because eventually and ultimately those things tend to get priced in. What I mean by that is, let's say, for example, that offices become less attractive. Everybody's using Zoom. And I think that's an easy conclusion to see a trend with, but at the same time, let's see what happens when we kind of get back to going out and doing things and so forth. Are people going to want to re-engage physically and in person? Are we going to completely abandon office space and so forth? But REITs do include things like apartments and other kinds of scenarios, some of which have been depressed, but if they're still existing, obviously partially maybe because they're getting government support and so forth, are they going to completely go away? Are they going to gobble up competitors at low prices? I think there's a lot of questions that are out there. And so when you're looking again from that longer term of, what kind of return you can expect, what I would say there is sometimes when the news looks very bad, what's actually happening underneath there is people are basically, the investors in that space are kind of being adjusted around that. Those that have tenants that aren't paying their rent, they may struggle financially and they may have to sell their building. And if you're invested in that building, that's not going to be a good thing. But if you're an investor able to buy that building at a very low cost, you might be able to come in and generate a very good future return. So maybe REITs today were a little bit challenged, or they've been challenged over the last year or two, partially because people are concerned about these issues, or these issues are very real. But at some point that does potentially create some opportunities, which is why, although I don't own REITs in my portfolio today, I keep them on my radar as a potential resource going forward. I want to share this with you briefly, and I'll circle back if you want to continue to follow up on this, because it's fun for me to talk about these things. But I want to get through some thoughts about what are some other ways other than through fundamentals that might help you, make these kinds of decisions or incorporate stuff like this into your thinking, into your portfolio. So I took away the individual asset classes and focused on sort of the balanced structure, if you will, just to make the chart less complicated and make it easier to see these kind of windows of time where being equally invested in stocks, bonds, golds, and REITs, for example, underperformed for an extended window, the traditional balanced portfolio, even though over the full time horizon, obviously in this particular case, they came out pretty neutral, partially to remind everybody that whatever strategy you place, whether it's an active or a passive strategy, and no matter how good or sound it may be over the long term, the reality of it is it takes a certain amount of discipline to stick to that strategy when you know that there are other strategies available that are doing better. So I just think it's helpful to be able to look back and try to be realistic about these things. The other thing I would share with you is if you look at charts like this one I showed previously, you'll see windows where gold was doing poorly, for example, yet it was still part of this allocation. And the other things were doing well enough to kind of keep you on track. And I would say, similar to the conversation we were just having about REITs, there can also be windows of time when they're doing poorly and yet they still potentially have a place in the portfolio, or at least in your thinking as part of a long-term strategy. So I am an unabashed tactical investment manager. In other words, I'm not afraid to say that I feel comfortable just with the idea of a random walk, looking at past data, projecting it forward, having an asset allocation, and just sticking with it long term. But I can understand why that's a very popular approach. And what I would argue is that whether you're a passive investor or an active investor, both require, as I mentioned earlier, a great deal of discipline. Passive investment, from my perspective, isn't necessarily about just stocks and bonds. It could be what we were talking about earlier, combining other asset classes and so forth. But it's that notion that we live in a world of a random walk. We can't predict the future. So we're going to allocate based on long-term data, and we're going to just rebalance regularly so that we're buying dips and selling into rallies. And the good news on that is if you've established a benchmark and you track your benchmark over time, you're never going to lag behind that. So that can provide a certain level of confidence when markets are not doing what you want them to be doing, or your portfolio is going down. If you look around you and you see that the same thing's happening to everybody else, a lot of times people feel comfortable with that. I'm not wired that way, but I get it. Of course, the offset is you'll never outperform. And what I would argue is if you're following a passive investment strategy, to a certain extent, luck plays a very big role in your success. As I shared before with sequence of returns risk, it becomes a major factor because when you happen to be at different stages of your life and therefore transitioning from building wealth and accumulating wealth to retiring and spending your money and so forth, if it happens to be at a good time, everything goes smoothly. If it happens to be at a bad time, maybe a little less so. An active strategy is a little different. Now you're going to be changing your allocation, either based on some kind of a model or based on judgment, or maybe a combination of those factors. This gives you the flexibility to respond to changing conditions. The downside is you may lag your benchmark, and at times you're almost guaranteed to lag your benchmark. But it gives you the opportunity to outperform, not just at times, but hopefully over time. And it does give you the ability through skill and risk management to offset some of the potential for bad luck. And I introduced these two concepts intentionally as two separate things. The skill being, if you're going to be engaging in active management, you're going to want to do your homework and make sure that you have a reason to believe that what you're doing is potentially going to be effective over time. And then I think risk management is just an important part of any strategy. And what I mean by that is it's kind of like if you go play cards at a casino and you're dealt a bad hand. If you get bored and just keep playing that hand, on average over time, it's not going to work out very well. But if you're able to make a little bit bigger bets when you have a very strong hand and lesser bets when you have a weak hand, on average over time, you can kind of do okay as long as you've got the resources to stay in the game long term. So I want to talk a little bit about some of the kind of common strategies just from a model-driven approach. And I'm going to keep picking on just these 4 asset classes only because I don't have time to go into a whole lot of other potential topics and so forth. So it's just mostly to give a sense that sometimes what might be intuitive to us may not reflect itself in reality, and especially because we hear a lot of these things from media pundits and so forth that resonate and sound reasonable. But then when you go to apply them in real life, they may not function quite as well. So I'm still showing you that same 30-year chart. I'm still showing you the traditional balanced portfolio in blue, and I'm showing you in black the equally weighted portfolio that is stocks, bonds, golds, and REITs. And this green portfolio and this red portfolio are simply taking a look back of the trailing 200 days, so roughly 11 months worth of 11 months worth of performance history, ranking them simply based on total return. And the green chart is sort of taking that notion that last year's losers are this year's winners. I'm going to buy the 2 that have suffered the most, and I'm going to basically just hold those 2 until the others start to do bad. I'm just going to kind of rebalance into the laggards, if you will. The red chart is on a monthly basis, looking at that 200-day history and just buying the 2 that are doing the best. And again, just rebalancing that based on these monthly rankings. Turnover is a factor, but it's typically not more than a couple of trades a year. And what you see is, on average over time, it's pretty hard to argue that momentum hasn't been a better strategy than sort of buying the laggards. I will say, as somebody who has learned to embrace momentum as an investment phenomenon throughout my career, there are caveats, and they're important to potentially consider working into your strategy. And that isn't what happens at inflection points. So obviously, if you're buying what's been working and then leadership changes, there's going to be a little window of time where that portfolio is going to need to adjust to that change, and what's gone up the most tends to get hurt the most. Unfortunately, that's pretty difficult to predict. The other window of time that I do think is relevant and relatively easy to capitalize on, if you're patient and just keep this in the back of your mind over time, is that after declines of 20% or more in the market, that is when mean reversion strategies really tend to shine. In other words, that's that window of time where whatever's done worst really tends to rebound more sharply. So if you look at the angle of this chart here relative to this chart, it's not that momentum didn't do well coming off the bottom, for example, in 2009, or most recently coming off of the COVID meltdown a year ago. But mean reversion did dramatically better for a window of time until you had a chance for, again, that sort of momentum to keep pace. So maybe considering de-emphasizing momentum if you're going to build that into your investment strategy after significant declines, can be a solution that comes in handy. Now, to give you, again, another thing to think about that has certainly molded my thoughts as a investment strategist about this sort of active versus passive investment mentality is there are these sort of bigger picture trends that happen that teach us, sort of from the market perspective, in my view, to maybe change our thought process over time. And the easiest way for me to illustrate this for you is to kind of walk back through the last 70 years. And I'm just going to focus on stocks because it's easy to relate to and maybe a little less complicated than throwing a bunch of different asset classes into the mix. So I'm going to start with 1950 through 1966, and that's what this chart shows here. So this is a 16-year window of time. And I'm characterizing this as a secular bull market. All that means is that over an extended period of time, although you have cyclical downturns and upturns, these downturns tend not to go back to the prior lows and to recover relatively quickly and breach new highs, such that a long-term investor is kind of rewarded, if you will, for buying the dips and staying fully invested. In this case, the returns are actually on the level itself, so they're not a total return, so they're actually better than this if you factor in dividends. But what you see here is an extended period of time where stocks face different setbacks, but they earned a decent rate of return. And investors during these windows get taught two lessons. One of them is it pays to buy dips. The second one is it's time in the market, not timing the market, that ultimately leads to wealth accumulation. In other words, if you just stay fully invested, you can go through these ups and downs and you end up in a pretty good place. And then this happens. So this is just continuing that same chart, except instead of starting in 1950 and going to 1966, I'm starting in 1966 and going to 1982. So again, a 16-year window of time, but a very different experience. In this case, of course, we had the inflation or stagflationary environment of the 70s. We had multiple recessions and so forth. But the bottom line of what happened here is you had these huge roller coaster swings, and every time you kind of got back above water, you went back down yet again, and you suffered through these ups and downs. And what happens is this type of environment teaches us very different lessons. So in this environment, somebody that's trying to kind of ride this out, they don't get much of a reward. In this case, I happen to finish my chart all the way out here. If I would have finished it in here, you can go 10, 15 years with returns that are flat to relatively negative. In this case, I allowed a positive 2% annualized rate of return. But you also suffer through these wild up and downs along the way, which most people won't be willing to ride through. So what people start to believe is, well, it's not time in the market that's going to make me money. In fact, stocks are a horrible long-term investment. But instead, if I can trade the market, if I can buy and sell and market time this thing, that's pretty much the only way people make money. And a lot of market timing strategies became popular and famous through this window of time. And of course, then we know this happened. So this is the big secular bull market environment from 1982 through 2000. So you can imagine that you just went through 16 years of these violent swings up and down, and you got to the point where people were just saying stocks are a horrible long-term investment. And the only way to make money is to time the market and sell when things go up because they're inevitably going to pull back. And then, it goes up and down, and somewhere in here, people sell their stocks, or maybe it's in here, thinking that okay, we're overdue for the next big bear market, and they miss out on all these wonderful gains. In this case, it was 15% annualized plus dividends. I mean, obviously a very phenomenal environment. Not to suggest that there aren't bear markets along the way. This is the famous crash of 87 in here and so forth. But again, they tend to be shorter and shallower and result in new highs. And of course, I've been sharing with you previously 2000 through 2013. And we all know what happened from 2013 to present. I can tell you, because I was giving presentations in this time frame, I remember, I want to say it was right around here, I was at the AAII conference, the national conference in Florida. And this was a topic that was very much on everybody's mind, was, oh my gosh, stock valuations are high, stock prices are back towards those prior levels. We're overdue for another pullback. What do we do? How do we know whether this is going to be the next outcome? We're going to kind of continue up, or whether we're going to go down. So it's not always easy to predict which environment you're in. And of course, that sort of brings me to where we are currently. How do we kind of gauge what are the behaviors that we should be using and incorporating into our strategy, whether we're going to take a passive approach or an active approach, given that this sort of secular framework is happening behind the scenes, and the activities that would make us profitable in one environment are the exact same activities that are going to hurt us in the other environment. And the short answer from my 20 odd years of doing this through both some of the best market environments and some of the worst market environments in history, is it helps to be humble and build in a little bit of both. So, consider, instead of strategies that take you all in and all out, strategies that allow you to adjust and move somewhat incrementally. And basically allow for that possibility that you're going to be wrong. And again, if you guys want to invite me back at some point, I can do a separate talk just focused on sort of the secular bull market, circular bear market phenomenon, and some of the cues and nuances that might help you identify, which of these you would be in. But what served me very well over time, anyway, has really been this concept of trying to stay flexible and respect that each of these environments is going to transition and happen at some point within our investment career. And so we want to make sure that we're building in some level of risk management. And we do want to allow ourselves, though, to just try to target, instead of outperforming every strategy out there, if we can just find a way to participate a little bit more in advances than we do in declines, over time, that seems to be more achievable and work pretty well. So I'm going to talk a little bit about things that I'm observing today that are influencing some of my thought patterns, unless somebody wants to ask a question about that prior topic. Great. So the first thing that I think is on a lot of people's minds, you're hearing about it in the media all the time, is valuations are high, right? And so that's scary. And yep. Oh, I thought there was a question coming up. I heard my little ding happen, but no, we're still good. This chart is showing the S&P 500 index over the last 30 years, and it's showing the PE ratio of the underlying S&P 500 index at the index level over that same time frame. And a couple things to point out. One is the average PE has been actually close to 20 over that time frame. That's what this line represents here. We've spent considerable time above and below. So a lot of people that think about now, PE ratio averaging, closer to 15, which is the very long-term perspective, you really only touched that a few times over the last 30 years. But second thing to point out is valuations are, in fact, quite a bit higher than they have been on average over this time frame. And the only two times they've been higher were close to those peaks in 2000 and 2008. What I want to also point out here is that historically peak valuations didn't happen at the peak of the market, but rather closer to and following when stocks troughed. So, partially to think about stocks as a leading indicator, which we've all heard about multiple times. But the other thing to recognize is that major market meltdowns do tend to correspond with recessions. And part of what happens is earnings get dramatically depressed, such that even after stocks have started to recover, PE ratios often expand somewhat dramatically, and it takes some time for earnings to catch up. And stocks don't necessarily have to drop precipitously in order to facilitate that. When you look at where valuations are today, I don't think anybody would argue that earnings are anywhere near comparable. I know you guys are in Silicon Valley. We've got a lot of tech companies that have done absolutely great. We've also got a lot of tech companies that aren't even designed to earn money, but we can talk about that separately. But I think everybody would acknowledge that as much as we've got policies in place to help forestall bankruptcies and things of that nature, when businesses are shut down, earnings are greatly depressed. And that is contributing, along with the rise in prices, to why PE ratios are so high. Where we go from here is probably going to be a combination of maybe some volatility like we've seen earlier this year. I'm sure we'll get some at some point, but also, we could continue to go higher. And if we do get a strong reopening and earnings do well over the next several years, you could find earnings play catch up, and the market doesn't necessarily have to have it all wrong. A couple of things that have us optimistic at our company, and again, I'm pointing this out not that you have to agree with me, but just because this is things that we can observe. While COVID cases, fatalities, and so forth are still very elevated and uncomfortable, they've obviously come off dramatically. Some of this because we've got better treatments. Obviously, we're all very encouraged about the vaccine. And at least per what we can see here, we're getting closer and closer at a very rapid pace towards that sort of herd immunity. Now, doesn't mean that we're not going to have setbacks or the new variants aren't going to pose an issue and so forth. But my base case and the reason I was willing to invest prior to now wasn't necessarily because we were going to hit herd immunity, everything was going to go back to normal immediately, but more that either we were going to get something like this or better treatments or so forth, or we were just at some point going to learn to live with this, just like we've learned to live with other, very unpleasant things in our lives and so forth. And I think ultimately we're headed in that direction. The fact that we've got these vaccines and the rollout is happening, and there is this potential for herd immunity and for us to put this behind us sooner than I think most of us would have assumed, looking back historically, is potentially a reason that again, things could maybe be a little bit better than anticipated. Another thing is savings rates do tend to get boosted during recessions because people are unsure and uncomfortable about their future. In this particular pandemic, we've got savings rates that are at pretty astronomical levels relative to history. Now, they were depressed for a window of time because we had a good period, and so forth, and people weren't maybe saving quite as much and so forth as the long-term average. But this huge amount of savings and huge amount of cash that's out there, some of it's worked its way into the markets already and so forth. I get that and I understand that, but a lot of that is really fuel for potential pent-up demand as we reopen and get to do things and so forth, and could be a reason why some of the pain that you normally experience in terms of that sluggishness coming out of a recession, just may not be as fierce as we move forward. You may actually see things once again, and we're starting to see that in a lot of areas. I'm going to Vegas for a wedding right after this, and what I'm hearing is bookings are unbelievable. We're not flying in this particular case, but airports are getting more crowded. People are traveling, people are doing things, and we're barely open. Again, I just think, we don't want to be overly optimistic, but we also want to guard against that tendency to be overly pessimistic as well, or to think we're smarter than the market or what have you. Interest rates, what now? Rising interest rates is obviously a big deal for a lot of folks. This is showing the 10-year Treasury yield, this is courtesy of stockcharts.com, since 2000. And I drew two lines in place here, one at the 3% yield, one at a 1.5% yield. And what I really want to focus on is that for the last decade or so, 10-year Treasury yields have been in this range from roughly 1.5 to roughly 3%. It goes a little above, goes a little below. And that what happened in the pandemic was yield plummeted. And it wasn't just about the Fed doing things. It actually started to happen before the Fed and so forth. But it was really because you had, basically a liquidity issue, deflation fears as opposed to inflation fears, if you will. And they were depressed to pretty unrealistic levels. In other words, you got down to a point where you were basically anticipating that at some point inflation would at least get close to that 2% that everybody's targeting. And yet you were willing to accept a 10-year yield. People were willing to accept of 50 basis points or so. And then, of course, it started to creep up a little bit and so forth. But then we saw this big shift from the end of the year to 1.75%, in just a couple of months. And a lot of people started to think this is all about inflation fears and so forth. And it is possible that that's part of it. But when you look at it within this broader context and you factor in that inflation goals are closer to 2% and our 10-year Treasury yield still only at about 1.7%. So it's below the rate of inflation. It's hard to look at that as anything to me other than just another sign of confidence building and sort of a return to something that's a little bit more normal. Because if we really thought inflation was going to run hot at say 3 or 4%, it wouldn't take that long for bond investors to start to say, I need to get a return on my investment that's more like 5 or 6% over time. And we're just not seeing that. Now, there's some regulatory aspects to that. There's feeling that the Fed's going to come in and manipulate prices and so forth. But we're talking about a pretty huge market here. So at least from my perspective, I think it's reasonable to not let yourself get too overly concerned about that. That said, I think it is important to recognize that a lot of the bond market does not perform well when interest rates rise. So a year ago, a lot of people were looking at the fact that yields were depressed and rates would eventually rise and say, well, I don't want to be in bond ETFs or bond funds because I want to be able to hold my bonds to maturity. And the problem with that is if you bought a bond a year ago and you were getting 0.75%, 10-year treasury bond, and now you could be investing at that same level of risk at 1.75%, you've sort of lost your liquidity. Your bond has taken a 9% hit, which is equivalent to roughly all of the income that you're going to generate over the time that you hold it to maturity. And if you were to sell it, and again, if you hold it to maturity, you've got this big opportunity cost and you're not keeping pace with inflation. And now if you were to buy 10-year treasury ETF, I would say you'd have the same problem. But the benefit to ETFs is you can get greater diversity than most of us can get trying to buy individual bonds. And there's so many different classes and so forth that are available that I think people are more likely to invest with that idea that they're going to be a little bit more agile. And so holding shorter duration or different types of bonds in your portfolio tends to happen for more people when they're buying funds and things of that nature, which just gives you more flexibility. So I want to show a couple of sample portfolios, traditional portfolio using ETFs. If you want to have a balanced portfolio and you want to be globally diversified, the great thing about it, very simple to implement, right? AGG is your aggregate bond index, SPY for your S&P 500, ACWI for a kind of a global benchmark, and then you just rebalance periodically and away you go. I wanted to show a sample of a tactical portfolio or what that might look like. It could take a lot of different variants, of course. This happens to be all made up of ETFs that we currently hold within portfolios. We don't use exclusively ETFs. We usually incorporate some individual stocks and so forth. But just to give you a flavor for, again, some of the different types of things that you can introduce as you try to maybe look for different opportunities in fixed income. I currently, for example, incorporate not just shorter duration, but some TIPS or inflation protected securities into the mix. I don't want to have as much in fixed income because I just don't see the long-term return potential. So I include some gold in the portfolio to help me manage the risk. I'm kind of aligned with Richard's thinking earlier that REITs aren't too exciting at the moment, but they're on my radar and I've used them successfully in the past. The other thing that I thought I could point out here is some of the thematic investment opportunities that are there in ETFs. So a momentum ETF, a dividend growth ETF. So if you want to incorporate different strategies, again, it's pretty easy to implement that. I want to touch on a little bit because I'm running out of time here. What are some of the asset classes that tend to do well if we do start to see inflation rising from low levels? Historically, it's been gold, commodities, emerging markets tend to do well, partially because they hold hard assets. So, one thing to kind of think about there is inflation's never really about rising prices. It's about the value of of your dollar diminishing itself. So you can't, you go to buy things with those dollars and they're just worth less and less. And so that's why tangible items tend to go up. And that includes property values and things that generate cash flows and so forth. The reason emerging markets tend to do well is they just have a lot of commodity exposure. I will share with you again, right at this moment, we're not seeing leadership from these areas. And I think that's important to point out for two reasons. One is no rush to necessarily go there, but also when you think about what's the market telling us as a leading indicator about should we be fearing inflation in any significant way, at least at the moment, we're not seeing that. But this is something to keep an eye on. potentially. Another possible opportunity that, again, we're not seeing at the moment, but it's absolutely on our radar, is that there does have this historical tendency for foreign stocks to cycle back and forth versus US in terms of one outperforming the other, and that creating opportunities for people that are willing to be somewhat agile in their asset allocation to add some value over time. And we're in a very extended window currently where the US continues to lead. Again, I could have had this same conversation with you 3, 4, 5 years ago, and I would have said it's been a pretty extended period of time that the US has been outperforming. So at least have foreign on your radar. And I wouldn't be embarrassed by having mentioned that. But the other caveat is the US is still leading, probably not yet time to make a change. But if you do want to make a change, again, thanks to ETFs, it's pretty easy to do so. You would just reduce your exposure to SPY and increase your exposure to either ACWI or EFA or something along those lines. And obviously, there's a lot of other options. So we've covered a lot of material. I hope you feel that we've included in that material kind of the 3 basic points that I promised I would share with you, or at least some things that you could have on your radar. I wanted to also share my contact information. I'm more than happy to, again, provide updates along the way, in the future, or to answer any questions we weren't able to answer online. But I really appreciate you sharing your Saturday morning, and I'm willing to stay on, but I know we've got another important speaker behind, and I appreciate all your time.